Welcome to XFO Intelligence Podcast, where we explore cutting-edge investment strategies for sophisticated investors. Today, we're diving deep into a revolutionary approach that transforms one of the most controversial investment philosophies, the greater fool theory, into a systematic, risk-managed framework. This analysis comes from our latest report on transforming speculative investment through deep augmented thinking. For those unfamiliar, the greater fool theory has been around for centuries. It's the idea that you can profit from buying overvalued assets by finding someone else, a greater fool, willing to pay an even higher price. We've seen this play out repeatedly throughout history: the Dutch tulip mania of 1637, the dot-com bubble of 1999, the housing crisis of 2008, and more recently, the cryptocurrency cycles of 2017 and 2021. But here's the problem with traditional greater fool theory investing. It's essentially gambling. It requires perfect timing, offers binary outcomes, either massive profits or catastrophic losses, and leaves investors vulnerable to emotional decision-making and herd mentality. What if I told you there's a way to transform this approach from random speculation into a systematic process with measurable expectations and controlled risk parameters? That's exactly what our deep augmented thinking methodology has achieved. This revolutionary framework doesn't eliminate the speculative nature of greater fool theory investing, but it fundamentally changes how we approach it. Instead of random gambling, we now have what we call systematic speculative intelligence. The framework operates on 4 distinct market phases, each with specific characteristics and optimal strategies. First, the discovery phase, characterized by low participation and high information asymmetry. This is where early positions can be established with favorable risk-reward ratios using 10 to 15% of capital. Second, the momentum phase, featuring strong directional trends and sustainable information flow. Here, we increase exposure to 30 to 40% of capital with trend-following protocols. Third, the Euphoria phase, marked by extreme connectivity and maximum information velocity. This is where the traditional greater fool theory becomes most dangerous, but our framework calls for position reduction to just 10 to 20% of capital and defensive structuring. Finally, the fragmentation phase, characterized by network breakdown and chaotic information flow. During this phase, we maintain minimal exposure of just 5 to 10% with maximum risk controls. The key innovation here is our multidimensional analysis engine, which continuously monitors 3 critical factors: network health assessment, system criticality monitoring, and sentiment diffusion tracking. This isn't just technical analysis, it's understanding markets as complex adaptive systems. For example, our network health assessment measures connectivity strength between market participants and analyzes information diffusion patterns. When network health scores drop below 0.7, we know it's time to reduce exposure. Our system criticality monitoring identifies early warning signals for phase transitions, those moments when markets are about to shift dramatically, allowing us to position defensively before others recognize the change. The performance expectations are compelling for qualified investors. We're targeting annual returns of 40 to 100% in favorable conditions while controlling maximum drawdowns to 15 to 25%. The framework aims for a win rate of 55 to 65% on individual positions, with risk-adjusted returns showing a Sharpe ratio of 1.5 to 2.5. But this isn't for everyone. Implementation requires psychological discipline to follow framework rules during emotional markets, patience during unfavorable phases, and the objectivity to identify phases accurately. It also requires a minimum capital commitment of $50,000 to allow proper position sizing and diversification. The daily operation involves a structured cycle: morning analysis to update network health scores and identify phase transitions, strategy sessions to review positions and identify new opportunities, systematic execution following predetermined criteria, and continuous monitoring throughout the session. What makes this particularly powerful is the adaptive learning system that continuously calibrates strategies based on phase effectiveness and historical pattern recognition. It's not a static approach, it evolves and improves over time. The transformation we've achieved is profound. We've moved from gambling to calculated speculation, from binary risk to managed exposure, from isolation to context awareness, and from short-term reactivity to strategic positioning. This represents the evolution of speculative investment, combining the opportunity recognition of the original greater fool theory with sophisticated risk management and systematic approaches required for sustainable success in modern financial markets. For high-net-worth investors looking to participate in speculative opportunities while systematically managing inherent risks, the enhanced greater fool framework offers a compelling proposition. It's not about eliminating risk, it's about transforming random speculation into skilled speculation. That concludes today's deep dive into transforming speculative investment through systematic intelligence. As always, remember that all investment strategies carry risk, and this framework involves speculative investing that may not be suitable for all investors. Proper due diligence and professional advice are essential. Thank you for joining us on XFO Intelligence Podcast. Stay tuned for more cutting-edge investment insights for sophisticated investors.